Hello everybody, welcome back. There are of course red flags in every single stock, but it's our job as the investor to determine whether those red flags are rational or not. So today I'm going to be sharing some of the qualities in companies that I personally, this is just me personally, like to avoid. Of course, everybody's situation is different, and I think that's important to clarify before I go on to some of these stocks, because your risk tolerance may be different from mine, your situation may be different from mine. That's something that's never clarified in some of these finance videos. So today I'll be sharing some examples, going over real examples in some certain stocks, and more. So if that sounds like a plan to you, smash the like button for me, subscribe, do all that good stuff. And check out the Do Dividend Stocks Not Drugs merchandise if you haven't already. The link's in the description. Thank you, and let's get into the video.
Hello, I like money.
Alright, the first quality is actually a really interesting one that I mention a lot in videos, but I'd actually further like to clarify today. And it's talking about fluctuating margins. Now, businesses that are not the strongest, in my opinion, can be easily impacted by macroeconomic conditions that are completely out of their control. As a long-term investor, this is not the most appealing thing. You don't want to be, questioning every quarter, every month, or whatever, whether your company's going to have a 5% margin or 50% margin. It's just not the thing you love to see in a core holding. And in my opinion, as an investor, every stock you buy should be a core holding. That's something that's kind of changed in my philosophy over the years. But here's an example of a stock that I actually own, Target. You could say Target's a retail company, and retail, and especially Target with their business model, it's heavily impacted by outside conditions that are not in Target's control. But here's the thing, it's your job as the investor to find when it's a low time and find when investors are being irrational and selling off the stock. Yes, obviously, over the long term, Target's margins are going to be fine. But in the short to medium term, a lot of investors don't think that. And yes, it's not the prettiest margins ever, but it's your job, once again, as the investor, to find when the stock is being undervalued. And that's going to be a different type of return for you. There's just a huge trade-off in value and actual risk. And so far with my Target holding, it's paid off pretty well. So ideally, you want to see margins that are consistent. It's going to be even better if you can find margins that consistently go up over time. That's really hard to find, but there's rare instances where it actually does happen. So consistent margins are the first thing that I'd like to look for, in inconsistent margins that are heavily impacted by outside factors. You want to do your due diligence there, I think. Next, I want to talk about something that I avoid now, which is capital-intensive businesses. Capital-intensive businesses are businesses that rely on large investments, large capital expenditures, and large amount of debts to essentially just run their business. In my opinion, I think there's way much better options, more efficient and economical options for you as an investor. There's no reason you should be investing in these kind of companies. Now, I think there are going to be some exceptions to this. To start off, businesses that are natural monopolies, utilities, telecoms. I would say more utilities though, because utilities are really like ride or die. Like, you can't go without them. With telecoms these days, there's more competition, and I'd say that there's more of a risk of like an AT&T customer going over to Verizon or vice versa. I just think that there's more competition, whereas with utilities, you don't really have much of an option. And I think utilities have a lot more leeway with the government, especially if they were getting into a tough economic time as we are in now. Look at a company like NextEra Energy or Southern Company. Both carry out a lot of debt. And for any normal company, that's a big red flag. But they're basically monopolies, as I mentioned, and they can get out of these situations much easier. They can work with the government much easier, and they have a lot more wiggle room. But with a company like AT&T, their debt is just something they naturally have to use, and it's not appealing to us as investors. It limits their growth, their returns to investors, the amount they can grow their dividend, for cash flows, and so much more. AT&T literally has $148 billion in debt, and you probably would think that they're being impacted by interest rates right now. Now, over the long term, this could be a good buying opportunity, obviously, but for me in my time horizon, this just makes absolutely no sense to be investing in companies with limited growth because of the debt. Here's a better example, which is Intel. Intel is not a non-fabless company, meaning that they're going to have to pay a lot more in order to run their business. This means Intel is going to have to pay a lot more money to invest back into their business. This led to them obviously cutting their dividend. Now, if you're a regular investor, you're not really investing for the dividend. This was obviously the right move for the business. But as an investor, and especially a long-term investor, you want to be avoiding dividend cuts. Dividend cuts are really never a good thing in any circumstance, no matter how you try and make it out. Capital-intensive businesses limit rewarding the shareholder in the medium term, and are also impacted by higher interest rates. It's something that you want to keep an eye out for. But obviously, you need to do a lot more due diligence here. You need to understand why the money is being spent, looking at earnings reports, financial statements, and so much more, because you can usually see when a dividend cut is coming. The next thing you really don't want to see is just companies hiking the dividend for the sake of hiking the dividend. And essentially, whenever you get a dividend hike or dividend growth that is below what inflation is, that's essentially like taking a pay cut. And it's the same way that dividend growth is like getting a pay raise. People build in so many excuses for these large mature companies that hike their dividend like 0.5% every year. And as me and my personal investing goals, objectives, and all that stuff, that's just absolutely unacceptable. An example of this is a company that I actually just recently sold out of like an hour ago, which is 3M. We can say recently, over the last few years, 3M has only hiked their dividend only about 0.6% annually. And we can see over the last 10 years, which typically is supposed to be great for companies, it's only been 5.85%, which is just above inflation. This is unacceptable if you're like not 60. And companies that continue to pay their dividend, even though it's really not the best move for the business whatsoever. Yes, it would be very unpopular if 3M like cut their dividend right now, but over the long term, that would be great for their business's health. They could spend a lot more money in share repurchases and have a lot of shareholder value at the end of the day. It's one of the big reasons that I sold out, and a video on that will be coming out soon. Like 3M's going to be losing a lot of their money to lawsuits, and I just feel it's extremely petty that at this point they're still kind of hiking it just to maintain their status as a dividend king. It's typically easy to tell, you could see that in companies. Next, I want to talk about something that might be a little unpopular with you guys, which in my opinion is over diversification in businesses. Now, I learned my lesson the hard way with 3M. With 3M, they are an absolute giant of a business. They're a behemoth, they're not going anywhere, they're so needed. But there are so many different moving parts in the business. At one, my circle of competency, I just don't fully understand the business. But two, there are so many more things that can go wrong than right in my opinion. A current example of a stock like this is United Healthcare. They're an absolute giant of a business, and they're so strong, their financials are amazing, but the one thing for me personally that's holding me back from buying, one, it's really hard to understand. I straight up don't understand this business, and it would take me a very long time to do so. And even if I took that time, I feel I still wouldn't understand at the end. There's so many moving parts. And when there are so many moving parts, in my opinion, I feel that there's so many ways that the business can just go downhill, whether it be through lawsuits, as you saw through 3M, failures, and yes, you want to see diversification in your business streams, but you also risk and give up having so many things that could possibly go wrong and completely send your business down the drain. Look at 3M, that's another perfect example. So you just don't want to have companies that are really, really impossible to understand and have so many moving parts. That's just me personally. A lot of people actually enjoy researching it like this, but me personally as an investor, that's just not my thing. And lastly, I want to talk about management. Now, management is a huge part in every investment thesis that I have in my portfolio right now. For me, what I like to see in management, I want to see management that has very good returns. I want to see management that buys back shares when the stock is undervalued or when it goes down. I want to see stable management. This is a huge thing for me, especially when they have good returns. I don't want to have a new CEO every year and a half. An example, this is Walgreens. They just can't seem to find their CEO. Rosalind Brewer left. Now they hired a new guy. I want to see managements that do the responsible thing. I want accountable management. Management that doesn't make up excuses every quarter. An example, this is Disney. Disney seems to be writing up excuses left and right for the last few years. Some of them are valid, some of them are not. But management's a huge thing that plays in my investment thesis, and you should be researching management for every single business you invest in. I want to thank you all for making it to the video. If you guys haven't already, smash the like button for me, subscribe. Check out the Do Dividend Stocks Not Drugs merchandise, the best looking merchandise for any investor. Thank you all for watching and Do Dividend Stocks Not Drugs, and have a good one.